A warm welcome to Patrick Johnston, one of the two co-founders of Captive Services. Your office is based in Reno, Nevada.
That's
Reno,
okay.
Nevada, yeah, 30 minutes from Lake Tahoe, pretty much. A beautiful place. So very nice to meet you. It was great to talk to you and your partner. That was a very interesting conversation, and Captive is fascinating to me. So without much ado, why don't you tell us what got you here in this specific business of captive insurance?
Yeah, sure. That's actually a kind of a fun story. So after I got out of business school, I went to work for my wife's family business, and that's in farming. And they've been farming for well over 100 years now in California. And during that time, it was a very, very bad time. We were specifically struggling at our dairy farm. And I had met a gentleman who worked in the agricultural industry, totally different than dairy farming. Very smart guy, and I was very impressed by him. And the reason I was able to meet him is a small investment bank out of the Bay Area was interested in agriculture. They wanted to meet me. I did a little work for them. And they introduced me to this gentleman. And just in speaking to him, he was an ex Goldman Sachs banker. And he told me at that time that his captive insurance company was the most profitable thing that they had, which impressed me greatly because they have a fantastic company. It's very large. And I was also impressed because I had no idea what he was talking about when he said captive insurance. So I felt like a real dummy. And I then asked him to explain it to me, and he did. And it sounded way too good to be true. So I went home and I did some research, and lo and behold, it turned out it is true. And of course, then I was like, wow, if we had had access to this 20 years ago in my wife's family business, we would be in a lot better position at that time. This was 2005, 6, 7, somewhere in there. It was 2007. And so I had this idea that, well, why don't, I mean, I understand why the very large companies have these, but what about these you know, big family companies, why don't they have more of these? And so I thought I really wanted to bring this specifically at that time to agriculture and agricultural families because there's a lot of risk in agriculture, and traditional insurance doesn't always do a great job of understanding and pricing those risks. So I decided at that time I should try to have a startup that would bring this to market. And it only took me something like 20 years to meet Jonathan to put the pieces together to finally bring this to fruition. And that's how 3F Captive Services came about. So I call it the world's slowest startup.
That's okay. How many years ago did you start it with
Oh, I think it's been 3 years now, 3, 4 years, something like that, since we were able to raise funds and get going.
Okay, so why don't you explain to our audience, for those of them who don't know, just like you know, what
Yeah.
captive insurance is, and then maybe situate the size of the business today after 3 or 4 years of activities, and
hmm
that would
hmm
be interesting for us to know.
Well, captive insurance is essentially an insurance company that is formed by and owned by a parent company. And that captive insurance company exists to insure the risks of that parent company. And where the power really lies, it lets the owner retain underwriting profits, customize coverages, and therefore manage risk much more strategically. But it needs to be operated like a real insurance company because it is a real insurance company. And it has to have proper risk distribution, risk sharing, claims managing, regulatory oversight, and all of that. So that's it in a nutshell. So I'd like to tell us, when we're talking to prospective clients, insurance companies make a lot of money, and you don't have to go do a very deep dive on the web to figure that out.
Yeah,
And you might as well get in on a piece of it, especially if you're an operation that is well managed and you manage risk effectively.
good. Okay, so now tell us what's your life like with your partner, Jonathan. What I know you have a
Sure.
network of providers, and the two of you operating it. So tell us.
So initially we started out basically focusing on agriculture and
Mhm.
agricultural companies because I knew that world very, very well. And to this day, I still own farmland and operate farms. I have them managed, so I'm full time with 3F. So that's where we started. And then, of course, word kind of gets around. And then what we find is where are markets where risk is mispriced or it's not available? Because again, you can customize the coverages.
Mhm.
So we've noticed a real need in, say, building, construction. That's a real problem. Insurance can be a real hang up there. Transportation is another one. I mean, we can work with any company, but
Mhm.
where's the real need? Where is there risk that is uncovered or either because the traditional market will not cover it, or it's so mispriced that people don't use those insurance policies. That's really where we look, and that's where the opportunity lies. So that's kind of our focus. It's just finding those areas. And who
Mhm.
knows, someone might call us tomorrow from a market that we never even thought of. And that's,
Mm.
we're there and ready.
Great. Yeah. Any trends that you've seen in the past 3 to 4 years that you've been working in this industry and business?
Yeah, well, one of the trends is that just like I didn't know what in the heck I was when I heard about captive insurance, what the heck it was. That's still an issue, right? The nice thing now is because there's so much information available, what took me a long time to maybe research effectively in 2007 is so much easier. And so, when we have clients that say, this sounds too good to be true, I simply tell them, well, go home, search in Google, put it into AI, and you'll find out I'm not lying. So
Mm.
that's the biggest trend that we see, at least in our company right now, from the client's perspective, that is.
Yeah. So how do you adjust, your business strategy to get your company to the next level after the 3 to 4 years? I'm sure you have goals. So, how do you
Yeah.
translate that into your strategy?
Well, one of the interesting things is we had a meeting not too long ago with we have a marketing firm that we work with. And when you sit down and you plan out your strategy for 6 months or however you're going to, get the word out and how you're going to approach customers, I said, I don't think we can do this 6 months out anymore. I mean, things happen. The AI is changing things so quickly, and we use a lot of AI in our marketing. So I said, we have to plan like 6 weeks because where this is going to be in 6 months, I'm certainly not smart enough to figure that out, right? And if I were, I probably would be in Tahiti right now. So we have to be far more nimble with what we're doing to respond,
Mhm.
given the changes that are happening so quickly.
Yeah. Yeah. Okay. So no goals. So what's your next level strategy? What would you like to see yourself in a year, 2 years, or?
Well, I want to keep plugging away at exactly what we're doing and onboard more clients and help more clients save money and reduce their risk.
Mhm.
And that's really my focus and the focus of 3F is
Mhm.
how can we make companies more robust, meaning they face less risk? How
Mhm.
can they retain more assets? And that goes for companies or family businesses. Captive can be very, very powerful for wealth transition, and we just want to see companies being more successful. And, I tell people, if they have a inkling of an understanding of captive insurance, what they'll often say is, oh, this is self-insurance. And as if they were going to switch to, the decision is, do I want to switch to self-insurance? Well, what I like to point out to them is you're already self-insuring. Everything that is not covered by your traditional insurance, you are self-insuring, but you're insuring it with cash, right? What I'm here to tell you and what I tell them is the question is not whether you're going to self-insure or not. The question is how much are you going to self-insure and how efficiently are you going to self-insure? And
Mhm.
doing it with cash is the least efficient method. The best tool for that today to self-insure efficiently is through a captive. And if you're of the right size and have the right risk exposure, it's sort of a no-brainer.
So because of tax reasons, right? As
Well,
as an insurance or?
Well, it's not so much tax. Obviously, insurance companies, whether they be captive or traditional insurance companies, they have great tax advantages. And that is often what our clients hone in on first. But, you could do a lot of reading out there. There are authors like Taleb and Kahneman and economists who write about this. Human beings are terrible at assessing risk. It's not that we're dumb, we're just terrible at assessing risk. And risk is almost always underestimated. So the beauty of this is, and if you sit down with a client and you talk to them about, let's talk about things that have happened to you over the last 10 years that you
Mhm.
didn't have covered and you didn't expect. Those things come to the surface very, very rapidly. And then they will, in their mind, well, that wasn't even insurable. Well, yeah, it is insurable. It's just not insured by the traditional market because perhaps the market isn't big enough for them to spread that risk. But
Mhm.
you're self-insuring, that's where we start, right?
Mhm.
So that's sort of the process. And it takes a while for people to get their head around it.
Understood.
But yeah, but
Okay. In the traditional model, when you insure more, you pay more. Okay. So is this the case in your model or not?
oh, like I said, it is a regulated insurance. Your captive is a regulated insurance company. So all the policies should, if you work with us, is what we do. All of the policies are priced by third party actuaries.
Mhm.
So those are actuarially based policies,
Mhm.
right? But when you pay a traditional insurer, if you have a loss at the end of the year, a covered loss, you're happy you had that, right? But you want to pay as little as possible for it. That's how we do everything.
Sure.
Within a captive, remember, if you pay your captive to cover your parent company for, let's
Mhm.
say, policy A,
Mhm.
whatever you pay in that policy, net of any losses, stays in and it earns interest, stays in your company. So, in that way, it's not the same calculus. You want to pay as little for a traditional policy as possible, but for your captive, you're not nearly as price sensitive because it's going from one of your companies to another company. And
Mm.
so, at the end of the year with a captive, if you have a loss, you're happy you had that policy in place because you have coverage.
Mhm. Mhm.
You do not have a loss, you're still happy that you had that in place because you put that money aside and it's either untaxed or taxed very favorably within the captive.
Mm.
So it's a win-win.
Got
That's
it.
why I say it's kind of a no-brainer if you're the right size.
I understood. Then thank you. Well, I understand that. So how many months of cash flows do you have in a captive typically to cover, any asks, any claims that you would have to fulfill?
Okay, so I think what you're getting to is, let's say I open a captive on June 1st,
Yeah.
I fund my policies,
Yeah.
and what if I have a loss that exceeds those policies?
Correct.
It's a question we get all the time because, yeah, your captive at that time, at the very beginning, is not as well funded as it will be in the
Sure.
future. But that's okay. So let's say you have $200,000 in your captive,
Yeah.
you have a $400,000 loss for your parent company.
Yeah.
So your parent company needs $400,000. Remember, in order to be an insurance company, you need to have risk shifting. So that
Yeah.
means one company covers the risk of another company. You've
Yeah.
got that covered as soon as you form your captive. But you have to have risk distribution, which means the risk is shared amongst a bunch of different companies or drivers or whatever the case may be. So you're likely, in this case, in a pool. So if it's a 50-50 pool, your parent
Uh-huh.
company would get $200,000 from your captive and $200,000 from the universe of all the other companies in your pool. So
Mm.
that's how it's covered. But if you're now the question is, well, what if it's a $500,000 loss and I
Yeah.
only have 200?
Yeah.
200 comes from your captive, the same. 250, because it's 50-50 of the loss, is going to come from the universe of other companies. But now
Yeah.
you're $50,000 short. Well, your parent company writes a check for $50,000 into your captive and it goes right back out,
Oh, I
back
see.
to the company.
Okay.
So it's almost like a capital call, but it comes
And
right, exactly right. Yeah. And that's all determined by the state regulator, right? How
mm.
capitalized it has to be.
So when you create a captive, as somebody who was insured by, farmers, let's say, and say, okay, I'm out, I'm doing my own thing. You do it with other partners. Yes, it's a collective.
Not necessarily. You're talking about a group captive.
Okay.
So there are we don't do a ton of those.
Okay.
And we have reasons for that. What we look to do are what are called cell captives. So we have the captive under which other cells are formed, and each of those cells are completely independent. We don't own them.
Uh-huh.
The parent company with whom we're working, they own them,
Okay.
right? Now they get risk sharing because again, they're in a pool,
Yep. Yep.
but those funds that go into their captive, that's all theirs in a cell captive.
But regardless, you still have to bring some capital, whether you're in a group or
Absolutely.
alone, that's expected that you would fund your captive.
Just like any business, you're starting a business,
Right.
right?
Yeah.
The trick is, I mean, the secret is we run it for you, right? So
Yeah.
you don't have to
Sure.
manage it or anything like that. But yeah, you do need to fund it initially. And what a lot of clients do is they start very small. They're
Yeah.
just kind of getting the hang of this. They put in a little, maybe they have an option of when we first price out their policies, they might have 20 policies to choose from. They
Mm.
might say, I just want to do these 3 policies this year.
Mhm.
They're dipping their toe in. It's totally understandable. They can change that at any time.
Mm.
So the next, they might call us halfway through the year and say, I want to do 3 more policies, right? I want to add those. And in 2 years, they may say, we want to do 10 policies, but those 3 that we used to do, we don't want those anymore.
Mm.
So it's very customizable in that way.
Well,
But I
that's
do want
great.
to say one thing. You said, so you decide that you're going to do this instead of with State Farm or whoever.
Yeah. Yeah.
It's not that that cannot be done, but we're specifically talking about the beginning of a captive,
Yeah.
particularly at the beginning. That's not what we look to do, to replace, because they're already buying those policies.
Yeah.
Presumably, they think that's a good buy given the risk that they are offloading.
Yeah.
But then we say to them, well, okay, you have all these policies. Those are nice. Keep those. Where are the holes in those policies? So we might
That's
design
a good point.
policies, right, that
Understood.
pick up the exclusions. And
Yeah.
what are the other things that your risks that your business faces that you just assume is just that nobody insures this? This is just business risk, right? How can we put that? How can we cover those,
Sure. Sure. Sure.
right, in a
So
captive?
you complete the puzzle.
That's a great way of putting it,
Yeah.
Francis.
Okay, good. So wonderful. So now I'm giving you a magic wand. You can wave it.
Yeah.
Okay, what is that you fix at 3F Captive Services?
Whew. What would I fix at 3
Fix or
if I
transform, within your
yeah,
circle of influence, and not the rate of the federal
sure.
government.
What would make our lives easier? That
Yes.
is very, very simple. I wish more companies in the range of, say, maybe 5 million in revenue to 100 million in revenue knew about captive insurance. The biggest issue for us is getting folks to understand it because it's a different way of thinking about handling their business risk. And just like what happened to me, when they first hear about it, the initial reaction is, wait, I've been in business for a while. Why haven't I heard about this? And this sounds too good to be true. If this
Yeah.
existed, I'd know about it. That's exactly what went through my mind. And I can see it going
That's
through
the case.
clients' minds or prospective clients' minds when we're talking to them. So if
Mm,
I could wave one magic wand, that would be it.
that's the one. Okay.
That's the one.
Okay.
Yeah.
Okay. And why don't you wave it? Have you tried anything?
Oh, but that is the challenge of our business, right? I mean, getting the word out, meeting with folks, talking them through it, helping them to understand. Of course, they're going to call their accountants. The problem is their accountants don't know anything about captive insurance. So
Mm.
often we have to talk to the accountants. I mean, incidentally, one of the things the accountants worry about is I have no idea how to handle the taxation of this, right? That's always a hurdle.
Yeah.
And when you work with 3F, the taxes on your captive, we have a firm that we work with that specializes in captive insurance, and they do everything. So the accountant of the parent business doesn't
That's
have to do
to do
anything.
it. Yeah.
Right?
Okay.
That's very important. The difficulty is just getting people to understand it,
Mm. Mhm.
you know.
I get it. I get it. Well, I think it's time for us to conclude. Thank you
Yeah,
so very much, Patrick. I think
thank
it's a
you.
fascinating arena in the controversial world of insurance.
Yeah,
So
right.
I think you're doing great work, and I can't wait to see your progress and having more customers and getting the word out in a very effective way.
Thank you. Thank you so much for your
No,
time, and I appreciate getting to talk to you today.
and likewise, absolutely. Thank you so much,
Okay. Okay.
Patrick.
Bye bye.
Let's